Before we can get to that case study, I think we need to set up why taxes are different in retirement, Clinton. A lot of it has to do with the fact that the money that you saved for retirement and in different investments are taxed differently when you start spending them.
Yeah, we think about the pre-tax balance that you have saved. You're deferring taxes until retirement. So assets that are in your 401k, if you've got pre-tax IRA, when you take those distributions out, those will be taxed at earned income brackets, similar to your working years and your paycheck.
Okay, so IRAs, 401ks, 403bs, pensions, generally taxed at your regular income. Social Security, though, Lauren, that one has a totally different formula.
Yeah, this is a surprise for a lot of people because some people think Social Security isn't taxed because, in fact, it wasn't taxed while you're working. But for a lot of people, most people in retirement, it is taxed. But we call Social Security tax favored because unlike the IRAs, the employer plans, it's not. There's a pension. There's a formula called provisional income that is a formula that takes your taxable income, half of your Social Security income, adds that together, and then that number will determine is your Social Security taxed, is part of it taxed, but at a maximum, 85% of your Social Security income could be subject to tax at your ordinary income bracket. So it's better in a sense that it's not 100% of the income that you take away from IRAs and 401k plans. At a max, it could be up to 85%.
And basically, I'm going to say it in real broad terms, it kind of depends on the other money that you make, how much you pay on your Social Security. That's what that provisional income is, right?
Yeah, the other taxable money that you make does go into that provisional income. So you add up all the taxable income, take half of your Social Security income, that equates to your provisional income, and then you apply that to the income brackets associated with that provisional income for Social Security alone to determine somewhere between 0 up to 85% of that Social Security income could be taxable.
Okay, we're talking about formulas. There's even a different formula for how the IRS taxes what the sale of stocks, bonds, and mutual funds.
Yeah, if we think about dollars that are being held in a taxable account, often referred to non-qualified or brokerage, those are dollars that as you realize gains or sell a position, you'll be taxed at capital gains rates. If you've held it for less than a year, that'll be short-term capital gains, which will be taxed at earned income rates. The goal is that often you can hold that for more of a longer-term approach, more than a year, and then that will be taxed at a preferred rate of long-term capital gains.
Okay, I think that does a good job of setting up how each investment could be taxed a little bit differently. But what people really want to know is higher taxes in retirement.
We're missing one. We're missing the most exciting one.
Oh, go,
Lauren,
yeah.
What is it? The Roth IRA.
Oh,
These are dollars that as you have those dollars put in, whether it's the Roth 401k or you're directly contributing to a Roth IRA, or you've converted dollars in, those are dollars that grow tax-free, and in retirement you can take them out without a tax bill. That's our favorite one. Those are tax-free dollars.
Tax-free money is the best kind of money.
That is the best kind of money, and that sets up the other kind of money, which is the money that hasn't been taxed yet. Well, guess what? When you go to retire, you're going to have to pay taxes on that money. And that kind of sets up the problem or the concern sometimes of pre-retirees when they get into retirement. They've got all this money in that traditional 401k. They've saved, they've done the hard work, but then it comes time to retire. And I've heard you say it can be kind of a ticking tax time bomb.
It can be, and it's a big surprise because at your required minimum distribution age, which now for most people is age 73. So what that means is all that money underneath the pre-tax IRA or 401k plan at your required minimum distribution age, let's say it's 73 for you, you are mandated to take a distribution from that balance, and then that distribution is taxable at your ordinary income. So we have to kind of fight this mantra that you have heard probably for the last 10 years at least, is that wait until you retire to do any kind of tax planning, because in retirement, your taxes will be lower. But for many people in retirement, that's not necessarily the case, especially when we project out long term over the course of a 20 to 25 year retirement. The first couple of years in retirement, your taxes might go down, but because of the RMD, this tax ticking time bomb that you referred to, it could force you into the same tax bracket as what you were when you're working, or for some good savers, for some people, it could actually increase your tax bracket for the rest of your retirement. And that's what we have to get control over in the tax plan.